Hello, and welcome back to our CMA exam revision series. In today's video, we will dive into the topic of long-term assets, focusing on investments in equity and debt securities. So let's get started. When you invest in equity securities, you become a partial owner of the entity issuing those securities. This ownership gives you certain rights, such as voting rights and the potential to receive dividends or capital appreciation. This section provides guidance for the accounting treatment of equity investments. It excludes those accounted for using the equity method, investments in consolidated subsidiaries, or investments that are accounted for using the fair value option. These exceptions have their own accounting rules and should be treated differently. The accounting method for equity investments depends on the level of influence the investor has over the investee. If the investor holds 20% or more of voting rights, significant influence is presumed. In such cases, the equity method is used to account for the investment. The equity method reflects the investor's proportional share of the investee's results and allows for the recognition of equity income. On the other hand, if the investor has effective control over the investee, the consolidation method is used. This method combines the financial statements of the investor and the investee as if they were a single entity. It reflects the investor's control over the investee and presents a comprehensive view of their financial position and performance. The measurement of investments in equity securities follows certain principles. Firstly, investments are valued at their fair value on each balance sheet date. Fair value represents the estimated market value of the investments, considering factors such as market conditions, supply and demand, and other relevant factors. Any unrealized gains or losses arising from changes in the fair value of the investments are reported in the income statement. Unrealized gains occur when the fair value of the investments increases, while unrealized losses occur when the fair value decreases. These gains or losses are recognized in the income statement to reflect the potential value change of the investments, even though they have not been sold. Equity securities investments involve considerations beyond fair value. Two key aspects to consider are the treatment of dividends received and the classification of cash flows related to purchases and sales. When dividends are received from equity securities, they are reported as dividend income. These dividends are recognized as income in the financial statements, contributing to the investor's overall revenue or income. Cash flow classification, however, depends on the purpose of the securities. If equity securities investments are made with the intention of actively trading or generating short-term profits, cash flows from purchases and sales are classified as operating activities. And if the investments are made with the intention of long-term holdings, the cash flows from purchases and sales are classified as investing activities. In certain cases, an entity may choose to use a cost-minus-impairment measurement alternative for equity investments that do not have an easily determinable fair value. Under this alternative, the investment is initially recorded at its cost. However, it is important to regularly assess the investment for potential impairment. If there are indicators of impairment, the investment's value may need to be adjusted. For investments with no readily observable fair value, it is essential to consider observable price changes in similar investments or other relevant factors. This helps in estimating the fair value of the investment and making appropriate adjustments if needed. Let's now explore the classifications of debt securities and how they relate to our understanding of investments. Debt securities play a crucial role in the financial markets, representing creditor relationships between investors and the issuers. Debt securities are categorized based on how they are held and traded. There are three primary classifications for debt securities. Held to maturity, these are debt securities that the investor intends to hold until maturity. They are typically acquired with the intention of collecting both periodic interest payments and the principal amount at maturity. Held to maturity securities are reported at amortized cost on the balance sheet. Trading debt securities are those bought and sold with the intention of generating short-term profits from price fluctuations. These securities are actively traded on the market, and any changes in their fair value are recognized in the income statement. Trading securities are reported at fair value on the balance sheet. Debt securities classified as available for sale are typically held for an indefinite period, with the intention to sell them in the future if favorable market conditions arise. Available for sale securities are reported at fair value on the balance sheet, with any unrealized gains or losses recorded as a separate component of equity until realized. That concludes our coverage of this episode. We hope this revision has clarified these topics and enhanced your exam preparation. Remember, practice is the key to success. Make sure to check out my CMA exam practice series. Thank you for watching. See you in the next video.